All right, financial accounting students, are you ready to tackle Chapter 10? As usual, I'm hoping you've already read the textbook and made your way through the chapter, but we'll get started. So Chapter 10 is about long-term debt. If you've been paying close attention, as we've worked through the last several chapters, we're essentially working through the balance sheet. In Chapter 7, we talked about current assets. In Chapter 8, it was long-term assets. In Chapter 9, we talked about current liabilities, and now here in Chapter 10, we get into long-term debt. There's not a whole lot of different types of long-term debt, but we will cover a couple of them here. So first, we're going to look at an installment note. Thus far, the types of notes payable that we've looked at were maybe a little bit unrealistically simple, where we borrow money from the bank and then we don't make any payments on it, and then we pay it all back at once plus interest, usually a year later. Oftentimes in the real world, when we borrow money, we have to make payments on it, just like if you were to have a loan on your car and make car payments. Or a mortgage on your house. You don't just say, oh, I'll pay you back at the end of 30 years plus interest. You make monthly payments on it as you go. So that's the type of debt that we're talking about here, called an installment note. So basic idea, a company says, oh boy, we need some money. And they go to their lender, and their lender says, okay, I will loan you some money, which is called the principal. And then the company is going to make payments on that loan over time. And each payment is going to cover interest for that period and a portion of the principal. So each payment covers the interest for that given period and a portion of the principal. So we're paying down the principal as we go. So at the end of the loan term, we should be down to zero. So with each payment, the interest portion is going to get smaller, and we'll talk about the mathematics of why in just a moment, and the principal portion is going to get larger. So as we pay down the principal balance, we are incurring less interest, which allows more of the payment to be applied toward principal each time. Here they tell us long-term notes are usually 2 to 5 years in terms of their term. That doesn't seem very long-term. I mean, it is long-term, 2 to 5 years, but typically when we think of long-term notes, in my mind, I think 10, 15, 20, 30 years, typically a mortgage on a home, so we're talking personal finances, 30 years. But you get into business lending, and suddenly 2 to 5 years is plenty long. It would be unusual to see a 10-year loan in business. Why do you think that is? I think a lot of it has to do with the risk involved. How does the lender know that your business is even going to survive or be around in 5 or 10 years, much less 20 or 30 years? When it comes to personal finance, lenders are usually pretty confident that you're going to live for another 5 or 10 years, hopefully 20 or 30 years. So it has to do with the risk that the lender is assuming by making that loan. So when we talk about installment notes, basically how it works, and I don't like reading a lot of words, so we'll go through it quickly and then we'll look at some numbers, for example. We're going to identify our unpaid principal balance, and then we're going to take that unpaid principal balance and multiply it by the interest rate, and that will tell us how much has to be applied to interest. Then we're going to take our cash payment amount, subtract the amount that we just applied to interest in number 2, and whatever's left is the amount that we get to apply to principal. And then we take our unpaid principal balance from the beginning, we subtract the amount that we just applied to principal in number 3, and that becomes our new unpaid principal balance going into the next period. So let's look at this example. It says January 1st, year 1, Blair Company issued a $100,000 face value long-term note to National Bank. The note had a 9% annual interest rate and a 5-year term. The loan agreement called for 5 equal payments of $25,709 to be made on December 31st of each year. It is a prepare an amortization table for Blair's note. Amortization, that's a Chapter 8 word. What's it doing here in Chapter 10? Amortization we talked about in the context of amortizing intangible assets. Do you remember what amortize meant in Chapter 8? It was to systematically allocate the cost of an asset over its useful life. And we use that in the context of intangibles. But what's that word doing here in chapter 10? Well, we're going to systematically allocate the cost of the loan, which is called interest, over the loan's life. So we are preparing an amortization table to systematically allocate the cost of the loan, which is interest, over the life of the loan. So we don't just expense it all at once at the beginning or all at once at the end. We need to expense it. We need to match it to the period that it belongs to. So let's take a look. Here, you just click the next slide and it's done for you. Isn't that great? Well, we should probably walk through and understand where the numbers are coming from, right? So at January 1st, year one, there's our original principal balance of $100,000. And then we're going to make a cash payment against that. So the question is, how much gets applied to interest and how much gets applied to principal? So we're going to take the principal of $100,000 times the interest rate, which was 9%, and we get $9,000. So the first $9,000 has to be applied to interest, and then the rest, 25,709 minus 9,000, so the rest being 16,709 gets applied to principal and goes to pay down our principal balance. So we take 100,000 minus 16,709, and that gives us our new principal balance, 83,291, which is what we'll start year two with. Then we do it again. So in year two, we make another payment of 25,709. So this time to compute our interest, we're taking our principal balance of 83,291 times 9%. So 7,496 has to be applied to interest, and then the rest goes to principal. So 25,709 minus 7,496, so the rest is 18,213, which gets applied to principal. And then we reduce our principal balance again by that amount. So we take 83,291 minus the amount that we applied to principal, 18,213. So our new principal balance is now 65,078. And then we start year three. So I won't walk you through each and every number. I think you get the idea that you could calculate years 3, 4, and 5. You'll notice in year 5 we're off by $1, so they round the payment up by $1. Question I get a lot is, how did they decide on 25,709? How did they know that that's the right payment amount? Because the interest all worked out and we come up with 0. Well, there's a mathematical computation that you can learn in order to do that, in order to get this figure of 25,709, but it's beyond the scope of what you need to learn for this class. If you're going to continue as a business or accounting major, I suspect you'll have an upper division finance class at some point that will teach you the mathematics of that computation, but I'm not going to bore you with it here. And then beyond that, typically what happens in that upper division finance class is that you'll get the privilege of buying a very nice financial calculator that has the capabilities of computing things like mortgage payments and installment note payments. So you'll press the buttons on your expensive magic calculator and it'll tell you that you need to make payments of $25,709. For this course, it's always going to tell you the payment amount, and it's been carefully calculated. It's not just a random number. If you think about it, if we take 25,709 times 5, over the life of this loan, we're going to make 5 payments, and that's a total of $128,545. So 100,000 of that is to pay back the principal, and the other $28,545 goes to pay interest. So what you see, if you take $9,000, right, 100,000 times 9% is $9,000, and you multiply that by 5 years, that's $45,000 of interest. But because we're making payments along the way, reducing the principal balance each year, we don't pay nearly $45,000 in interest. Ultimately, we're going to be paying roughly $28,545 of interest, plus or minus a couple dollars for rounding in here. So by paying down the principal as we go, we're reducing our interest payment and allowing ourselves to apply more toward principal each period until, of course, we end up with 0 at the end. And that's really important. Anytime you take out a loan, whether it's a personal loan or a business loan, whether it's to buy a car or a house or to finance your new business or to buy equipment or machines for your new business, anytime you take out a loan, I think it's really important to ask to see the amortization schedule and to understand the numbers that are here. Look at that principal column and make sure that it eventually arrives at 0. Look at your interest expense column and make sure that it's going down over time. Look at that principal repayment column and make sure that your principal payment is going up over time. Well, why do I say all this? Isn't that just obvious? No, not all loans are created equal. Some don't have these features. Some don't arrive at 0. Some have large balloon payments at the end. Some of them are what you would call a negative amortization loan. I don't know if you listen to the radio or hear ads on TV, but there's all kinds of ads for lenders and people that want you to refinance your house or get out of debt. And a lot of times there's like that kind of fine print language they have to read either at the beginning or the end of the advertisement. And it'll say something really fast. Blah, 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 blah. This loan may contain negative amortization. Wait, what? Negative amortization? What does that mean? Well, here's an example. Let's say that instead of paying $25,709, listen, I like you so much and I know you need this loan and this loan is going to be life-changing for you. So instead of making you pay $25,709 every year, I like you so much, I'm only going to make you pay $8,000 a year and I'm going to loan you this $100,000 for 5 years. And all you have to do is pay $8,000 a year. Does that sound too good to be true? Yeah, and therefore it probably is. So here's what would happen. So picture this in your head. So instead of $25,709 here on year 1, we're going to pay $8,000. How much of that would be applied to interest expense? Well, it'd still be $100,000 times 9%. So the interest expense would still be $9,000. So what's going to be in our principal repayment? Negative $1,000. Can you even fathom that? So that's a pretty scary thought that the loan balance is going to go up over time. In fact, here's what it would look like. I filled in a couple numbers just so you can kind of visualize this. So we make a payment of $8,000, of which $9,000 has to be applied to interest. So again, that principal repayment is negative $1,000, forcing the balance up over time. So now we start year 2 with $101,000. We make another payment of $8,000. This time we're taking $101,000 times 9%. So $9,090 goes to interest. And now our principal repayment is negative $1,090. And now our new principal balance goes up again. It's going to start going up exponentially at a curve. $102,090. So over time, our loan is going to grow. So when I say not all loans are created equal, and anytime you take out a loan, I want you to look at the amortization schedule. That's why we can't assume that every loan has the great features of ending at 0. This loan clearly is not going to end at 0. It's going to arrive at a principal amount higher than what you borrowed. How are you going to pay that back? There's a time and a place for that type of loan, but it's rare and unusual. So you need to make sure you know what you're signing your name to. And I would strongly advise that you use loans that arrive at 0 at the end. So that's my little soapbox about long-term loans. Visually, in terms of what we're looking at, that split between interest and principal over time, the payment stays flat, in this case $25,709, but the combination of principal and interest changes, with the principal amount growing and the interest amount shrinking as the overall principal balance gets paid down each year. So in terms of accounting entries, when we first borrow the money, we're debiting cash and crediting notes payable. And of course, our cash flow is financing activity because we're borrowing money from a creditor. And then when we go to make a payment, it's going to change a little bit each year depending on the amortization schedule. So we'll debit interest expense. So for year one, it was $9,000. We'll debit notes payable, $16,709, and then we credit cash for the whole amount. And now that combination of interest and principal is going to change each year in accordance with the amortization schedule that we prepared. So we'll need to use that to do these journal entries. What's important to note over here on the side under cash flows, the interest portion is OA, operating activity, because interest is always an operating activity for cash flow purposes. And the $16,709, the principal repayment, is FA. It's FA when we borrow the principal, and it's FA when we pay back the principal. So if we were to do this for 5 years and look at our financial statements, what we'd see over time is our interest expense going down, down, down. And we see that our notes payable is going down each year. So this is the ending balance at the end of year one, end of year two. So at the end of year 5, we pay the whole thing back. We're back to 0. In terms of our cash flows, the overall cash flow, the sum of the interest and the principal portion sums to the same thing, $25,709 each year. But we have to break it out between interest and principal. So the interest goes in the OA section and the principal repayment goes in the FA section. So that's installment notes. You'll have a couple homework problems to help you practice that. So our next topic is line of credit. And I will be the first one to say that I don't think your textbook does a very thorough job explaining a line of credit and particularly how to compute it and the journal entries that would go with it. So I'm going to try to cover what the book gives you, but then give you some examples from your homework that'll help you understand and reinforce those ideas. So basic idea, line of credit typically is going to be used for short-term seasonal finance needs. So a business might have a slow season and a busy season. In fact, pretty much every business has some form of slow season and busy season. Ask a small business owner, they can probably tell you what that is. And to the extent that they might need a little help with their cash flow during that period, a line of credit might be the perfect lending instrument for that. A line of credit shouldn't be used for the long-term financing needs of the company to buy equipment, that kind of stuff, but truly for short-term seasonal cash flow type needs. So the idea with a line of credit is that it enables the company to borrow and repay funds as they have cash available. So they borrow only when they need the money, and then they repay it when they have the funds to do so. In the meantime, they just have to keep up with the interest payments. But being able to borrow and repay as you are capable can allow you to manage that outstanding principal balance and ultimately keep the interest expense down. So that's the idea with the line of credit. You go to your bank, you apply for a line of credit, and I would always recommend to apply for a line of credit exactly when you don't need it, because that's when you actually qualify for a line of credit. So if you are running a small business, you should apply for a line of credit even when you don't need one. That way you're qualified for it in case you come across some short-term cash flow issues. Then you have a line of credit available at your bank. And the bank's usually going to specify a maximum credit line. You might apply, do all the paperwork, and they'll say that you qualify to borrow up to $50,000 or $100,000. And then as you have cash flow needs, you can borrow that money from the bank. If you wait until you have cash flow needs and then you apply, first of all, it might be too late. And secondly, your financial statements may not look very strong and may not support you getting or qualifying for that line of credit with the bank. So I always recommend that you apply for one exactly when you don't need one, and you don't have to borrow the money right away. That's the great part of a line of credit. You can qualify for it, but you don't have to borrow it. You can just leave it at the bank and not pay any interest on it. So that's all that the slides give you about line of credit, which is honestly very inadequate. So I'm going to jump over to a problem from your homework and we'll talk through some of that. Okay, so here we are looking at question 2 from your chapter 10 homework, which is a line of credit problem. So we've got Singer Company has a line of credit with United Bank. Singer can borrow up to $400,000 at any time over the course of year one. The following table shows the prime rate. So the prime rate is not the interest rate the Singer is going to pay. That's the bank's interest rate. Okay, that's like their internal interest rate. So the prime rate expressed as an annual percentage along with the amounts borrowed and repaid during the first 3 months of year one. So Singer agreed to pay interest at an annual rate equal to 2% above the bank's prime. So we might call that prime plus 2. So they're going to pay the prime rate plus 2. So funds are borrowed and repaid on the first day of each month. And then interest is payable in cash on the last day of the month. The interest rate is applied to the outstanding monthly balance. So for example, Singer pays 6.5%, which is going to be 4.5% prime plus 2% annual interest on the $140,000 for the month of February. So let's walk through that a little bit, make sure that we understand. So in January, we borrow $80,000. So start with just recording that at January 1st. So we're going to debit cash and credit line of credit payable for $80,000. Now at the end of January, we decide we don't have enough cash to pay back any of that principal. So we're just going to pay the interest. That's it. So we're not going to pay back any principal at January 31st, but we're just going to pay the outstanding interest. So we're going to take the $80,000 outstanding and multiply it by prime plus 2. So 80,000 times 6%. What do you get? 80,000 times 0.06. I get $4,800. Well, that would be interest for a whole year, remember, because these are annual interest rates. We just need to pay interest for 1 month. So we take 1/12 of that. So divide by 12, and we get $400 a month. And we're going to go ahead and pay that interest in cash. That's our line of credit agreement with the bank. The interest has to be paid every month. So we don't have to pay back the principal, but we have to keep up with the interest. So in February, we borrow more money. We borrow another $60,000. So we debit cash, credit line of credit payable, and now we have to pay interest again. So it's the end of February, and we've decided we don't have enough cash to pay back any principal. So again, we have to compute and pay the interest. So our outstanding balance at this point is $80,000 plus $60,000. We have $140,000 outstanding, and we have to pay prime plus 2. So 4.5% plus 2, we have to pay 6.5%. So I take $140,000 times 6.5%. I get $9,100 for the year, but that's for a whole year. I just need to pay for 1 month. So again, I take 1/12 of that, and I come up with $758 rounded. So we have to pay out $758. So we debit interest expense and credit cash. So I'll let you guys go ahead and do March on your own for the homework. That will kind of conclude our line of credit, and I hope give you a better idea of how to manage that in terms of borrowing the money, paying the interest, and then the journal entry aspect of it. So again, a line of credit, great tool for short-term cash flow needs, not necessarily the tool we want for long-term needs. So speaking of long-term, this next debt instrument is bonds. When we talk about bonds, corporate bonds, this is a serious long-term debt instrument. So you guys have probably heard people talk about stocks and bonds, but usually they end up just talking about stocks. Bonds are a long-term debt instrument that a corporation might use in order to acquire a large amount of financing. So if you have a corporation and they need a serious amount of financing, they essentially have 2 options. One is to issue stock, and the other one is to issue bonds. And so that's what we'll learn here in Chapter 10. When we issue stock, that's equity financing, and the stockholders may not love that. We've talked about this before. Why would a stockholder not want us to issue more and more stock? If every time we need money, the corporation issues more stock, what could be bad about that? Well, it dilutes the ownership. So essentially it's taking your piece of pie, if let's say that the earnings per share that the company makes, we'll talk about that at the end of the chapter, but It's taking that piece of pie and it's slicing it up smaller and smaller to share it with more friends, with more stockholders. So the stockholders may not want you to keep issuing more and more stock. They may want you to take on a responsible amount of debt, and that can be done in the form of bonds. Now, when we need a serious, large amount of money for long-term borrowing, we don't always want to just go to the bank and borrow in the form of an installment note. Remember, they said an installment note, a long-term installment note, might be 2 to 5 years. Here, when we talk about bonds, realistically, we're talking about 10, 20, 30 years. So when we say long-term borrowing and large sum of money, we mean seriously long-term and also seriously large sum of money. This isn't something that a small business is going to do. This is something that a big business would do, and we're talking about seriously large sums of money with lots of zeros on the end. So that large sum, of course, is called the principal, and the principal is going to be paid back as a lump sum at the maturity date. So we're not making payments on it as we go. We're going to be paying interest on it as we go, but the principal will be paid back as a lump at the maturity date. And then this is just info you're expected to know. Individual bonds are denominated with a face value of 1,000. So that's your default assumption unless you're told something different. So they're usually going to be 1,000 face value. So that's default assumption unless a particular problem tells you otherwise. Periodic interest payments are going to be based on a stated rate of interest. And again, a default assumption that interest is going to be paid semi-annually. Unless you're told otherwise. Some of the problems will have you pay it annually, but your default assumption is semi-annually. And then to compute our interest, same as what we've been doing all along, we take the principal times the interest rate times the time outstanding. Well, if it's semi-annually, then it's 6 months, so 6/12 or 1/2. If it's annual interest, then it's just principal times interest rate times 12/12 or 1. Another thing you need to know about bonds is that bond prices are quoted as a percentage of the face amount. What does that mean? Well, it's a terminology thing. So we might say, oh, well, a $1,000 bond is priced at, or it's selling at 104. And you would be expected to understand that lingo and know that that means it's selling for 1,040, 104% of face value. So if I told you that a bond is selling at 98, what does that mean? Well, first you'd have to know that we assume that the bond has a $1,000 face value unless you're told something different. And I said that it's priced at 98. So that's a percentage of the face. So that means 98% of 1,000. So it'd be selling for 980. What if I told you a bond selling for 102? That means 1,020. Or if a bond is selling for 96, that means 960. Hopefully you're catching on to that. The simple way, if we have $1,000 face value bonds, is just add a zero. If I say it's selling for 104, just add a zero, and now it's 1,040 in terms of dollars. So that's the simple way. So advantages of bonds: longer term to maturity than notes payable issued to banks. So the bank, like I said, 2 to 5 years is long term, and you might even have to renew or reapply for your loan within those 2 to 5 years. Or if it was longer, you'd likely need to renew your loan, meaning you have to re-qualify for your loan. And then secondly, bond interest rates are typically going to be lower than bank loan rates, significantly lower. So when a corporation needs a large sum of borrowing for long term, bonds are usually the better option in terms of longer term to maturity and lower interest rates. Sometimes a bank can't offer what a corporation needs, so bonds become the only alternative. So again, basic idea: corporation says we need a serious amount of money. Stockholders don't want us to issue any more stock. The amount that we need is larger than what the bank is willing to loan us, so we are going to issue bonds. So they issue bonds to this group of people over here that your textbook has labeled investors. I don't think they mean that as a technical term, investors, because you know what? These people are not investors. Now, individually, they might think of themselves as investors. They might think, oh, well, I'm investing in stocks and bonds, right? So we invest money in stocks. But when it comes to bonds, now those individuals, they're making an investment. Why would they buy a bond instead of a stock? Well, bonds are usually viewed as a little bit more conservative investment instrument, and they might be looking for steady interest income over the long term, which is a little bit different than what stocks are offering us. So they're investing in something different than stocks, maybe with the purpose of having steady interest payments that they earn over time. So they view themselves as investors. They're using their money and investing it in something. But technically to the corporation, those people are creditors. Investors are owners, stockholders. These are not investors. These are creditors. They are lending money to the company. So I don't like that they labeled them as investors. I'd like to relabel them as bondholders or creditors, but I won't be difficult about it as long as we're all on the same page. So the corporation says we need a large sum of money, and the stockholders say, do not issue any more stock. We don't want to have our ownership diluted any further. Please issue bonds. Please use a responsible amount of debt. So the corporation issues bonds to this group of investors, creditors that would like to put their money into the corporation. So they get a bond certificate at face value, and they give money to the corporation that's to be paid back later. So that's the issue date. Then over time, we're going to be making steady interest payments to those bondholders. So that'll happen over the life of the bond. They get steady interest payout. And then at the bond maturity date, they get paid back in full. So they get all of their money back. So the bond principal gets paid back to these bondholders at the maturity date. So for them, they let the corporation hold on to their money. They receive steady interest payments, and they get their money back at the end. So they've gotten what they wanted, and the corporation got the use of their money for all of those years, however long that might be. Things to read about in your book, I'm not going to go over them in detail here, is secured versus unsecured, meaning is it collateralized? Is it secured by an asset? Term versus serial, and convertible versus callable. That's all just some basic terminology. I'll let you read in your textbook. Let's get to the example. Bond issued at face value. Mason Company issues bonds at face value to investors on January 1st, year one. The investors pay the how about bondholders? The bondholders pay the bond selling price equal to the principal of $100,000 to the company. Stated interest rate is 9%. The interest is paid annually, not semi-annually, but annually on December 31st, and the maturity date is December 31st, year 5. I have all kinds of complaints about this example. First of all, they said it was supposed to be a large sum for long term. $100,000 is not a large sum. $100 million is a large sum. $100,000, now that might seem like a lot to an individual, especially maybe a student, but when it comes to business, $100,000 is not a large sum. So add 3 more zeros on the end, now we're talking. And then they say that it's a long term, 5 years. You're not going to issue $100,000 of bonds for 5 years. You'd issue $100 million of bonds for 20 years. And then they said that the interest rate should be lower than what a bank would charge, yet they're still using a rate of 9%. Bond interest rates wouldn't be anywhere close to that. Try maybe like 2 or 3%. So I have all kinds of complaints about the example here that it's unrealistic. But either way, we can still learn how to compute and record our journal entries. And they've chosen these numbers as a side note because they match the numbers from the installment note that we looked at several slides back. So we will be able to compare the difference in cost of a bond versus an installment note for the same amount, same interest rate, and same term to maturity. So what happens? At the issue date, we are going to debit cash for $100,000 and credit bonds payable $100,000. So our cash is going up, our liabilities are going up, and the cash flow, of course, is FA. These creditors are financing our business, so financing activity. Then As time goes by, we have to pay interest. So at each interest payment date, Mason has to pay $9,000 to the bondholders. So we take principal of $100,000 times 9% times time outstanding, which they didn't even bother to show because it's a full year, 12/12, the whole thing. So we're going to pay out $9,000 to our bondholders. So that looks like this. So we're debiting interest expense and we're crediting cash. So interest expense is going up, which is making net income, and therefore retained earnings go down, and our assets are going down because we're paying out cash. And the cash flow is OA. Paying interest is OA. So every year we have to make this entry and pay interest to those bondholders. Then at the end of year 5, we're going to pay back the full principal amount. So we pay back the full $100,000 to the bondholders. So we're debiting bonds payable, we're leaving the liability entirely, and we credit cash. So cash is going down, liabilities are going down, and the cash flow is FA. It was FA when we received the $100,000, and now it's FA when we pay back the $100,000. So that's a bond issued at face value. On our financial statements, it looks like this. I know this is kind of small, a little bit hard to read, but we see steady interest every year, 9,000, 9,000, 9,000 all the way across. In terms of our bond, it's 100,000 at the end of each year, except for at the end of year 5, we would have paid the whole thing back. And then on our statement of cash flows, we see those steady payments of 9,000 a year. And in the FA section, we see the inflow from issuing the bond and the outflow when we repay the bond. So that's bond issued at a face value. You should first practice that and get a good grasp on that before you dive into the next 2 topics. So what if we don't issue the bond at face value? So bonds aren't always issued at face value. They can be issued for more or less than face value. So here we're going to look at bonds issued at a discount, and they say use the straight line method to amortize bond discounts. So we'll learn what that means in just a second. So basic idea, if bonds of other companies are yielding more than 9% that Mason was paying, investors or potential bondholders would be unwilling to pay the full face value for Mason's 9% bonds. So somebody else is offering to pay 10%. Why would you want to buy Mason's bonds that are only 9%? That doesn't make a lot of sense. You're going to be attracted to the 10% bond. The issue price of Mason's 9% bonds will have to be lower to entice investors and potential bondholders to want to buy them. The difference between the lower issue price and the principal of $100,000 is what we call a discount. So Mason's going to keep issuing their bonds at 9%, but if other people are paying 10%, they're going to have to issue at a discount. So here's what that might look like. So Mason's still issuing bonds, and the principal of those bonds is $100,000, but they're going to sell them to these bondholders for only $95,000. So for each $1,000 bond, each bondholder is going to pay $950, meaning they're issuing the bonds at $95. So at $95, meaning $950 for each $1,000 bond, and in total, the principal is $100,000, but they're only going to receive $95,000. So there's $5,000 missing. That's what we call the discount. The rest of the facts are still the same. The stated interest rate is 9%. The interest gets paid annually on December 31st, 5-year term to maturity. So the only change is just the issue price. So we're issuing the bonds at 95. So at the issue date, here's what it looks like. We're debiting cash for $95,000. We're crediting bonds payable for the full amount, $100,000, because that's what we're going to have to pay back. And that difference in between is discount on bonds payable, and it's a debit of $5,000, obviously, to make this balance. That's a new contra liability account. That's a new term, a contra liability. So it's an offset against your liability, which is bonds payable. So it's a negative liability. So we've got cash going up, and then bonds payable goes up $100,000, while discount, that's a minus discount, is bringing down the liabilities side of the equation. And the cash flow is FA, financing activity. So that's at the issue date. On our balance sheet, we're going to show bonds payable, 100,000, and then immediately beneath it, we show less discount on bonds payable. So that's our contra liability, and our carrying value is 95,000. That's important terminology this chapter. So face value is 100,000, or the total principal we would say is 100,000, and the carrying value is 95,000. Well, that's going to change over time. We're going to have to figure out how to use the straight line method to amortize that bond discount, meaning to systematically allocate the cost of the bond discount over the life of the bond. So we're going to do that using the straight line method. So we're going to amortize the discount over the term of the bond, which is going to end up increasing our interest expense each payment period. So we take $5,000 and we divide it up over 5 years. So that's $1,000 per year. So each time we pay interest, we're going to amortize that bond. So what does that look like? When we pay interest, I want you to start at the bottom of this 3-line journal entry. And this will be the same idea whether it's issued at a discount or a premium. I want you to start on the 3rd line. No matter what, we're going to pay our bondholders $9,000, 9% interest on $100,000. So we're going to be crediting cash $9,000. In terms of the discount on bonds payable, if I go back a couple slides, remember here, discount on bonds payable, that was a debit of $5,000. How do you make a debit of $5,000 go away over the course of 5 years? Credit, credit, credit for 5 years, $1,000 per year. We're going to credit discount on bonds payable for 5 years. So that's exactly what we're doing here. So start at the bottom with the cash payment amount, which will be 100,000 times 9%. Then credit discount on bonds payable. You're making it go away. So credit 1,000 to discount on bonds payable. And then the interest expense is the sum. So amortizing that discount pushed our interest expense overall up to $10,000. And if you think about it, probably back in line with the market rate of interest. Why did we issue our bonds at a discount again? Because other companies were paying higher interest. They were paying more like 10% interest, while we're paying only 9% interest. So this act of amortizing the bond discount over time pushes our interest expense back in line with the market rate of interest, not just a coincidence. So when we look at our accounting equation here, cash is going down. Our liability side is going up. I know that's confusing. There, I changed it so it's not a double negative. So I'm adding the discount. So we're adding up our liabilities, but remember, discount is a contra liability. So the credit is making the liability side go up, while the retained earnings is going down. So we have 9,000 outflow for cash, and that outflow is OA. And then our entry over here, liabilities are going up as we relieve that contra liability, and then our retained earnings is going down due to the $10,000 interest expense. So a little bit complicated, but as you do this journal entry, I really encourage you start with the bottom line, which is the cash payment. And whether our bond is issued at face value, discount, or premium, which we'll learn in just a moment, the cash payment to the bondholders is going to end up being the same, principal times interest rate. And in this problem on Mason, it's always going to be $9,000, 100,000 times 9%. And then you look at how do I make the discount on bonds payable go away over the course of 5 years? Well, it's a debit balance, so I'm going to be crediting discount $1,000 for 5 years. And then the interest expense is what makes our journal entry balance. So what's happening on our balance sheet? So at the end of year 1, now our discount on bonds payable is down to $4,000, and our new carrying value is $96,000 at the end of year 1. So think about that. If we do this again each year as we pay interest, at the end of year 2, our discount will be $3,000, and our carrying value will be 97. At the end of year 3, carrying value will go up again to 98. At the end of year 4, the carrying value will go up once more to 99. And then at the end of year 5, our discount will be fully amortized, and our carrying value will go up to 100,000, and then we'll pay the whole thing back. So the carrying value has to increase to exactly $100,000 at the maturity date. And by amortizing that bond discount over time, we're going to arrive right at 100,000 at the maturity date, and then we're ready to pay the whole thing back. And paying it back is simple. We're just debiting bonds payable, crediting cash, and the cash flow type is FA. So what if we did this semi-annually instead of annually? I mean, it was convenient and all that they had us do it annually. It's half as much work. But if they're going to have us do it every 6 months, we can still do it the same way, but just divide it by 2 and do it twice. So in terms of our interest payment, it'd be 100,000 times 9% times 6/12, or 1/2. So instead of paying out 9,000 once a year, we're going to pay out 4,500 twice a year. Instead of amortizing the bond discount 1,000 for 5 years, we're going to amortize it 500 every 6 months for 5 years, so twice a year. And then our interest expense is the sum of those, so the offsetting debit of 5,000. So all of this still adds up to the same as our annual, but we're just doing it twice a year. So now we're going to look at it from the other perspective. What if our bond interest rate is better than others? We might issue at a premium. So now we're going to use the straight line method to amortize bond premiums. And then again, here's the idea. If bonds of other companies are paying less than 9%, so let's say other companies are offering 8% bonds, creditors, potential bondholders, I still don't like that word investors here, will be paying, they'll be willing to pay more than the face value for Mason's bonds because they look good. They're better than everything else on the market. So if everybody else is paying 8% and Mason's paying 9%, there's going to be high demand for these 9% bonds. Well, when there's high demand for something, what can we do? Increase the price. So there's going to be high, they say investor demand. I'm still stuck on the word investor, creditor demand. The difference between the high issue price and the principal of 100,000 is called a premium. So let's look at Mason again. So it's still the same principal of 100,000, but this time they're going to issue the bonds at 105, meaning 105%. So each individual bond, face value of 1,000, the bondholder is going to pay 1,050, and overall, Mason Company is going to collect 105,000. So they get 105,000, but the principal that has to be paid back is only 100,000. The rest of the facts are the same. Interest rate is 9%. They pay it annually on December 31st, 5-year term to maturity. So this difference between our cash proceeds of 105,000 and the bonds payable is what we call a bond premium. So at the issue date, we record it like this. We're debiting cash for the full 105,000. We credit bonds payable for the principal amount of 100,000, and then the extra 5,000 goes to a new liability account called premium on bonds payable. So we credit premium on bonds payable for 5,000. And of course the cash flow is FA, that's money in from the financiers, the creditors of our business. So on our balance sheet, what's going on? So on our balance sheet, we show bonds payable $100,000, and then immediately beneath it, we show our new liability account, premium on bonds payable for 5,000, and then 105,000 is the total, and again, that's called the carrying value. Well, guess what? This premium, just like the bond discount, the premium on the bond also has to go away over the course of 5 years. So we're going to take that 5,000 again and divide it up by 5 years, and we're going to be amortizing $1,000 off of that premium each year, bringing it down to 0 at the maturity date. And again, we're amortizing the premium, meaning we're systematically allocating it, we're breaking it up, and we're offsetting it against our interest expense each year for 5 years over the life of the bond. And what you'll see is that it's going to end up decreasing our interest expense. So at the end of year one, it's time to pay interest, at which time we also need to amortize the bond premium. And again, I encourage you to start on the third line of this journal entry, which is still the same. $100,000 bond times 9%. We have to pay out $9,000 of interest to our bondholders. That's not negotiable. That's going to stay the same. So then we amortize the premium on bonds payable. And remember, that was a credit. If I go back to when we issued the bonds, right, we credited premium on bonds payable for $5,000. So how do you make a $5,000 credit balance go away over time? Debit, debit, debit for 5 years. So we come back to here. So we're debiting premium on bonds payable $1,000 each year for 5 years. And our interest expense essentially is the plug figure that makes this balance. It's the difference that makes our journal entry balance. It's $8,000. So the act of amortizing this premium on the bond ends up making our interest expense go down and probably back in line with the market rate of interest. Remember, why were we issuing these bonds at a premium again? Our bond interest rate was better than the market rate. So if everybody else is paying 8% and we're paying 9%, people are going to be attracted to our bond and we can issue it at a premium. So here what we see is the impact of then amortizing that bond premium ends up pushing our interest expense down and probably back in line with the market rate of interest. So the cash flow for the interest is OA, and what we see over here, we've got cash is going down. We have some problems in here. Let me fix that. There we go. That looks better. They left the word discount in there instead of premium. So our premium is going down with a debit, and our retained earnings is going down because of our interest expense. So we've got negative $9,000 on the asset side and negative $9,000 on the liabilities and equity side. So when we do that, what's happening on the balance sheet? Well, what we see is that our bonds payable is at $100,000, and then I just fixed this. They had it wrong in the slides. I hope it's right in your textbook. We add the premium on bonds payable, which is now down to $4,000 because we just amortized $1,000 off of it. And we've got $104,000, which is the carrying value. So again, in terms of terminology, $100,000 is the face value or the principal, and $104,000 is now the carrying value after we amortize for 1 year. So as we amortize each year, so at the end of year one, it's at 104. At the end of year two, it'll go down to 103. At the end of year three, it's going to be 102. At the end of year four, it's going to go down to 101. And then guess what? At the end of year five, it's going to go down to exactly 100,000 at the maturity date. And then it's going to be time to pay the whole thing back. So let's go ahead and pay the whole thing back. So it'll look like this. We're going to debit bonds payable and credit cash. And that's it. So just debit bonds payable, credit cash, 100,000. That's been the same thing we've done each time, right? So paying back the bond should always look the same. And the whole thing is FA, financing activity. So in review, as we look at bonds issued at face value, which was the simplest one we did first, and then we looked at bonds issued at a discount and bonds issued at a premium. To me, this table kind of overcomplicates it, but what it's trying to tell you is that if the stated rate of interest on our bond is the same as the market rate, the same as what everybody else is offering, then we just issue the bond at face value and we don't have to worry about any premiums or discounts. However, if our stated rate of interest on our bond is less than the market rate of interest, what everybody else is offering, then we're going to have to decrease our bond price. We're going to have to issue it for less than the face value in order to entice people to want our bond. And therefore, we're going to issue it for less than face value, and that's going to create a bond discount that will need to be amortized over the life of the bond. On the other side, if our stated rate of interest is greater than the market rate, what other people are offering, then we're going to be our bond is going to be in high demand, and we can increase our bond price so that it's above the face value of the bond, which will result in a bond premium. And again, we'll have to amortize that bond premium over the life of the bond. So that's all that this table says. To me, it seems a little bit unnecessarily complicated, but just think about it. If everybody else is offering a bond at 10%, do you want our bond at 9%? No, you're going to have to put it on sale. You're going to have to offer a discount. But if we're offering a superior product, if we're paying 9% while everybody else is paying 8%, then we have a superior product and we can increase our price, meaning issue it at a premium. So the next topic is bond redemptions. I don't want to get too in detail with it. It's just a kind of a minor topic, but maybe a little bit complicated. I want you to focus on bonds issued at face value and a little bit of bonds issued at discount and premium. As we get into bond redemptions, it becomes a little bit trickier. I'll quickly run through this example, but it doesn't need to be the focus of your study. So on January 1st, year 4, which is 3 years after the issue date of the bonds, Mason Company redeems its 9% bonds that were sold at a discount. The bonds have a call provision, so that's terminology of this chapter. So a call provision allows us to pay the bonds back early, but that call provision requires that Mason pay a call price of $1,030 for each $1,000 bond. So really what it says is we have to pay the bonds back at 103, 103% of face value. At the call date, the bonds have a carrying value of $98,000. So we're 3 years in, right? The bonds issued at a discount. Remember, we received $95,000. There was a $5,000 discount. So we're 3 years in. So it went 96, 97, 98. So we need to compare that carrying value with the amount that we're having to pay back, which is 103% of face value. So 103,000 versus our carrying value of 98,000 looks like we're going to have a loss on redemption. Let's take a look at the journal entry. I like to focus on journal entries, as you know, and I'm going to ask 3 questions, my favorite 3 journal entry questions. So we're redeeming the bonds early. What do we get? Well, let me help you with that. We don't get anything. We get the privilege of not continuing to pay interest on these bonds for the remainder of their lives. So we are saving 2 years of bond interest, which is $18,000 of cash that we're not paying out. So that's what we get, is the privilege of not continuing to pay interest, but there's no debit or credit for that. Okay, so what do we get? Nothing. What do we get rid of? Well, we get rid of the bonds payable debt, which is $100,000. So we're debiting that right off the books. And we also get rid of the remainder of the discount on bonds payable. So we credit discount on bonds payable. Remember, that was a contra liability account. So that's the $98,000 carrying value, $100,000 minus $2,000. What else do we get rid of? $103,000 worth of cash. And then finally, question 3, what's the difference? And the difference is a $5,000 debit in order for this journal entry to balance, which we call loss on redemption of bonds. So that's the basic idea with a bond redemption. Is it okay that we suffered a loss on the early redemption of these bonds? Well, yeah, if we have the cash on hand to pay it back, we've suffered a small loss, but what we don't have to do is pay out $9,000 of interest for each of the next 2 years. So we've saved ourselves $18,000 of cash by paying the bonds back early. So that's the early redemption of a bond. So this next topic, effective interest rate method, we're not doing this. So you can skip all of this. Skip all of the effective interest rate method. Skip, skip, skip. And then finally we get here to the end where we talk about the advantages and disadvantages of debt financing versus equity financing, essentially. So the idea of financial leveraging, we've talked about in a previous chapter, I think. Put simply, financial leverage is the idea of, why should I use my money to make money for me if I could use your money to make money for me? So the example that they're offering here needs a little explanation. So let's say a company says, okay, we need some money, and we can either get it by taking on debt or by issuing more stock, which would be equity financing. So they've laid out this hypothetical situation. So either way, the company has revenue of $60,000, and they have expenses, excluding any interest, of $40,000. So their earnings before interest and taxes, what we call EBIT, earnings before interest and taxes, is $20,000. Now, if they take on equity financing, let's say that they issue stock. Let's hypothetically say they already had $100,000 in stock outstanding, and they issue another $100,000 of stock under the equity financing option. So they don't have any debt, and therefore they don't have any interest expense. So the pre-tax income stays at $20,000. But under the debt financing option, hypothetically, they take out a loan of $100,000 with 8% interest, and therefore they have to pay $8,000 in interest expense. So under the debt financing option, their pre-tax income is $12,000. Well, now it's time to pay taxes. Well, as a business owner, would you rather pay taxes on $20,000 or $12,000? You've got to pay 30% tax. So 30% tax on $20,000, you have to pay $6,000 to the government. 30% on $12,000, though, you're only paying $3,600 now in tax to the government. So your net income under the equity financing option is $14,000, where under the debt financing option, it's $8,400. So clearly a difference, but not the $8,000 difference that we saw up here in their pre-tax income. So the pre-tax income was a difference of $8,000, which was interest. What's the difference between $14,000 and $8,400? $5,600. So the difference now has been reduced down to $5,600, which is 70% of $8,000. Why? Because the other 30% was made up for in taxes. So the overall impact is that paying the interest resulted in tax savings, and the difference here is $5,600. Now, hypothetically then, let's say under the equity financing option, we've got more stock outstanding and we decide to pay dividends. Now, we all know dividends are not an expense, so that doesn't reduce our taxable income or our tax. And ultimately, if they pay $8,000 in dividends, which would be the response to $8,000 in interest expense. So they're trying to play this scenario where either way you have to pay out $8,000. Ultimately, the $8,000 in interest is a better choice because it reduces taxable income and therefore income tax that you have to pay. Here, under equity financing, we have the higher net income, but then if we choose to pay out a dividend of $8,000, our addition to retained earnings is only $6,000, where under debt financing, it remains at $8,400. And that would assume that we're paying zero dividends. But that said, I want to look at essentially the return on investment here. So if we're looking at a return on investment or return on equity, we're taking our net income divided by stockholders' equity. So under the equity financing option, our net income was $14,000. So this net income right there, $14,000. And then we were assuming that we had to issue an extra $100,000 of stock. So that brought our stockholders' equity to $200,000. So that would be our ratio, our return on equity ratio under equity financing. While under debt financing, which I spelled wrong, debt financing, we've got $8,400 of net income divided by only $100,000 of stockholders' equity, because the other $100,000 is debt financing instead of equity financing. So what does that work out to? Which one's better? Well, if we do the math, if we're dividing these numbers, here we've got a 7% return on equity. What do you think it's going to be under debt financing? It's 8.4%, of course. So what's better? Well, according to return on equity, if you're a stockholder in this company, you prefer the debt financing option. You've got $8,400 of net income to be shared among $100,000 of stockholders. Or think of it as your $8,400 piece of pie that you have to share with 100,000 friends. So you get a bit bigger slice of pie under the debt financing option. Under equity financing, you've got a larger slice of pie, $14,000 of pie. Think of net income as your pie, but this time you have to share it with 200,000 friends. So that's going to be a smaller sliver of pie then, right? So the 8.4% return on equity is better than 7% return on equity. So when it comes to financial leveraging, we see that using a little bit of financial leveraging actually works well in this scenario. Of course, taking on debt always needs to be done in moderation and responsibly, but mathematically it actually works out better. Despite the lower net income, it's okay. So that's a smart use of financial leveraging. Times interest earned ratio is your net income plus interest expense plus income tax. So what we're doing is taking your bottom line net income and adding back interest and taxes, or what we would call EBIT, earnings before interest and taxes. So some income statements will give you EBIT, earnings before interest and taxes, right in front of you. Others, you'll have to back your way into it by taking the net income and adding back those two items. And then you divide it by your interest expense. And what we're trying to find out is the amount of resources generated for each dollar of interest expense. So in general, not always, a high ratio is viewed as more favorable than a low ratio. So we want to be able to show that we're generating adequate amount of earnings relative to the amount of interest expense that we have. The one thing I would say is that they're saying a high ratio is viewed as more favorable than a low ratio. I say it's viewed as being more safe. If your ratio is extremely high, it might be because your interest expense is extremely low. So if your denominator, your interest expense is really low, your ratio would end up being quite high, which almost might be too conservative. It means that maybe we're not taking advantage of positive financial leveraging. So that may not totally thrill stockholders if the company is issuing too much stock but isn't willing to take on a moderate amount of debt and spend a little money on interest expense. So it depends. Too high may not be favorable, but in general, a higher ratio is more favorable than a really low ratio, but it does get to a point where it might be extreme and viewed as too conservative. So this is a ratio among many others that we have looked at the end of our textbook chapters that you might want to consider in terms of the research for your group project. So that concludes chapter 10. I hope this has been helpful. You guys know where to contact me if you need anything.